On today's Hashi, I'm discussing what happened yesterday with real estate stocks, industry analysts on markets and the rates, as well as buyer agent commissions. Today is Tuesday, August 6th, 2024. I am Byron Lazine, and the hot sheet starts now. Welcome into today's hot sheet. Let me know in the live chat which market you're tuning in from. And if you're new to the hot sheet, let us know that as well. Hit that thumbs up so more people can gain access to the only show on the internet that goes live every Monday through Thursday that the markets are open for a 24-hour look back on the housing market. Hit that thumbs up and share this so more people can gain access to that information as we widen the gap between agents of change and everybody else. Also, subscribe to the channel if you haven't done that already as well. All right. Yesterday, we saw the worst day on the S&P 500 in nearly 2 years. The Japanese stock market had the worst Monday since Black Monday, 1987, the worst day, losing 12%. What's happened since then? Japanese market has already regained about 3/4 of their losses yesterday. In fact, they just had their best day since 2008. So quick recovery there. How does the U.S. markets look? And how's the 10-year, of course, reacting to those new markets? Just as important for us as we look at the housing and the interest rate sensitive market that we operate in. Dow opening up a little bit down after having some pre-market activity. S&P's up a little bit. NASDAQ's up a little bit. So S&P 500 rises as benchmark tries to recover from the worst day in nearly 2 years. So that's what's happening here up to the moment. Yesterday, though, during that global sell-off, there were some real estate stocks that went down. Really, all of them, all but one. You can see here, EXP was the only gainer on the day. Maybe Leo wants to write us a thank you note here at BAM for giving EXP CEO Leo and the company so much publicity a week ago. I'm obviously kidding there. Okay, this is an article that we posted on nowbam.com. And here were the update on yesterday's stocks. You had Real down a tick. And look at these numbers here, down 5.22%, Remax down 4.68%, Zillow down 3.45%, CoStar down 3.41%, Anywhere down 3%. The SPDR fund was down 2.89. Redfin was only down 1.35. Compass was down less than half a point, and EXP was actually up 0.8. So EXPI, Compass performing the best for residential real estate brokerage stocks and portal stocks for yesterday. Okay, so those, even Redfin was beating the losses that the rest of the market saw. Okay, Real has been on a run up as of late. So that might have been a coupling of, okay, we've got a global sell-off happening as well as a stock that's been pretty hot as of late. Like if we go to just take a look at Real in particular, and I'll show you what I mean. Like where Zillow's been down. Okay, Zillow's been down. So oh wait, why are we not getting it? Here we go. Here is Real REAX. This is one that has been, if you kind of follow their earnings calls, they usually pop there. It's been an easier one to, I'm not suggesting day trading, and this is not financial advice, but this has been an easier one to take a look at if you know what's going on. I mean, look at just in the last month, they went from $4.50 up to almost $6 after an earnings report. Okay, so they had an earnings report in somewhere in here. You can see here, kind of bouncing from $3.50 up to $5, down to $3, up to $6, now down to $5.20. Here today, they're up a little bit. Okay, to start the day. All right, so that's what your real estate brokerage stocks did yesterday. Now let's take a look at Homebuilder stocks, because these have been the best performing of the entire market for the last year and a half, right? The entire stock market hasn't performed as well as these stocks. We've covered this on the hot sheet in the past, where we break down how well national home builder stocks have performed. Toll Brothers was down 5.14. Meritage Homes down almost 5. Tri Point Home down almost 5. LGI was down 4.5. KB was down 3.7. Pulte down about a little bit more than 3.25. And then Lennar was down 2.3. Now, my expectation would have been going into yesterday was, okay, we're going to experience a global sell-off. They're going to go down, but maybe they're not going to go down as much as the market did. And obviously there were stocks that went down more than these real estate stocks. But I would have anticipated that, home builder stocks and others, when they saw the 10-year drop, that maybe that softened some of the losses on real estate stocks. Okay. That you might have had a landing spot that they wouldn't have gone below. Like, if, for example, if you had really negative news going interest rate, pushing the interest rate up instead of down, obviously yesterday's news was negative. I'm not saying it wasn't. Obviously, a global sell-off, uncertainty in the Middle East is very negative, but it pushes the rates down. If you had negative news that, for whatever reason, pushes rates up, then you'd probably see deeper cuts, in particular for companies like Zillow, and obviously the home builders. If you saw rates really go up, the home builders would then, take a move. The home builders have done so well the last year and a half because they've had the inventory. Okay, so that's where we're at right now. That's where we're at. Just a little update here for all the Bitcoin people. You're at 50. Got a little bit of it back, 55,000, but I don't know, like a week ago, you were at 70,000. So still a little ways to go, down 16% in the last 5 days for Bitcoin. I think that surprised a lot of people yesterday, where there was all this uncertainty and Bitcoin's supposed to be the digital gold, and it plummeted yesterday after all this uncertain news. So keep an eye. The real estate market or the real estate stocks is something that intuitively well. And so when you see opportunities, yesterday was certainly a buying opportunity for some stocks. If you have that belief, maybe it was, maybe it wasn't. That'll obviously remain to be seen. But watching those and understanding where they're going is obviously a good thing to do as a real estate professional. I always say, if you're I hear agents all the time that are so worried about, Zillow. Well, did you buy the stock when it was $20 and it went up to $200 during COVID? Did you sell at 200? Had you bought at 20? Did you buy at 15? Did you enjoy that run up? If you were so worried all those years that Zillow's coming in and, stealing this or doing that or whatever, why wouldn't you have gone and hedged your bet? Same thing, right? Like if you feel like there's a company right now that, I don't like what they're doing, they're doing this, they're doing that, and you feel like they're bucking the old trend, maybe hedge your bet. Or if you really believe in somebody's growth or whatever, go ahead and place a bet on that. Oftentimes, we see that EXPI was up yesterday, Real was down. Oftentimes people tell me that they're joining one of those two companies based off of accessing some stock. I'm like, yeah, I own the stock too. It's anybody can buy it, right? So if you believe in a company, you can obviously go out there and buy the stock. And those opportunities are available to everybody. And understanding those is obviously paramount to making that bet. This is not financial advice. All right, let's take a look at industry analysts. Housing Wire put out a report that fears of a U.S. recession now. You're going to hear this probably a lot up until September's rate cut. Are we in a recession? Are we not? Q2 GDP numbers, are they going to revise that down? Almost every number that gets revised right now in this year, in this first half of this year, when the revision comes out, it gets revised down. That's leading to a lot of fears that people read those top line numbers, right? We had a over 2% GDP read in quarter two. There's a lot of fears that when that revision comes out, it'll be under 2%. And there's a lot of, even the jobs report that we had Friday saying unemployment at 4.3%. There's some belief out there that when that gets revised, it could be higher. There's obviously some people that are saying, no, it's going to be stronger. Okay. There's going to be a lot of pressure on the FOMC to go ahead and make a rate cut if people are in fact losing jobs. And we know that more people are losing jobs as we've gone from 3.5% to 4.3% unemployment. Okay. So the U.S. recession fears are going to be in the conversation We don't know if we're in a recession, if we're entering one yet. We don't have enough data. We have some speculations, okay? And there's people that believe that we're not, that we're still, the soft landing is still possible, okay? But you're going to have this conversation. You're going to hear about this conversation over the next couple of months. Typically, when you have the conversation, the fear around recession, I see luxury real estate buyers and investors drag out the process, take a little bit longer, kind of, more of a wait and see approach. I think for those in the median price points and under, or maybe even just over the median price points, especially from a buyer, this is a time to be aggressive. You may have that seller who's watching their 401k, who saw their 401k yesterday take a hit, who might be nearing retirement years, wants more stability financially, has had their house on the market for 3 weeks, who might now have that little nudge to negotiate a better price for the buyer. Okay, so I think it's a time to be aggressive right now while the headlines are uncertain, while the volatility has ratcheted up. I'm aggressive with my buyers in those price points, understanding that my luxury buyer, seller, investor are all going to move just a little bit slower, obviously outside of being super hot on a particular deal for whatever situation. But those luxury purchases don't have to have them. Going to move a little slower in the short term to understand what's going on, to understand, can I get a better deal down the road? Okay, so this turbulence of the financial markets is going to be a benefit. It's expected to be a benefit to the U.S. mortgage market. That's why I keep cautioning. I've been cautioning people on the hot sheet. If you're new to the hot sheet, then you don't know this. But if you've been here with us every single morning, you know this. I've been cautioning people rooting for 5% interest rates. I've been really critical of anybody promising 5% interest rates. I mean, we just had this crisis yesterday, and we still didn't get anywhere close to 5% yesterday on the Mortgage News Daily survey for the 30-year fix, right? But I was real cautious about rooting for low fives, because rooting for low fives always meant more people losing their jobs. It always meant that we have recession fears or are in a recession. If we were going to go from 7.5 or October 2023 at 8%, all of a sudden down to 5%, carving off 3% in a year, it always meant some type of economic crisis, whether that be from the commercial building, office building sector, whether it be from, the bankings, right? The local banks, whether it be from, a job market that goes up over 5% interest or 5%, unemployment. It always meant bad things, rooting for lower, than 5.5 or low 5% interest rates. Would we all want a perfect world where everybody's, that's not the reality. That's not how these things work. Okay. So I didn't like the just unrealistic, I want to live in a fairy tale land, 5% rates for no reason other than let's just put them at 5. Let's just pick a great number. Okay. Bad things would have had to have happened. And now there's this recession situation that's potentially happening, and we're seeing a lower interest rate. There's uncertainty in the Middle East, and we're seeing an interest rate drop. Okay. And so, yeah, the turbulence is going to benefit the U.S. mortgage market and ultimately benefit those that are restricted by interest rates in this real estate market. Home builders are gonna maybe have a little pop for this, and maybe real estate agents are going to see a little bit more demand over this short period of time, whatever this period of time lasts. Maybe it drives down lower and the period of time extends, but at what cost? Okay, at what cost? And so I even have that conversation. I would have that conversation when I'm talking to consumers. Oh, wow, the rate, it got down to 6.34 yesterday, but I'm going to wait till it gets lower. Okay, well, what else are you waiting for? Like, what else? What's your experience when rates drop significantly? What else is happening in the world? Are we going to enter another 100-year pandemic? Are we going to enter what looks like World War III? Like, is something really bad going to happen? Because for us to get down under 5%, if that's what you're waiting for, yeah, we're talking major recession. We're talking a huge pullback in global economies. We're potentially talking about escalation, war. We're talking about crazy political things potentially that could happen. For us to have that big of a swing, remember, CME Group has 100% priced in that, and we'll go to it. I'll just show you. CME has 100% priced in the fact that in September, we're going to get a federal rate cut. That's already priced in quite a bit to the markets because CME Group has been reporting this for about a month now. Okay. The next FOMC meeting is not for 43 days, but this has been priced in for a while. You have a 100% chance, 100% probability that in September, we're going to get a rate cut. Okay. Now it's down to 25% chance that that's only a quarter rate cut. And it's now up to 75% chance that that rate cut is going to be 50.5. Okay. 50 basis points on the federal target rate. Okay. That is already priced into where we see the 30-year fix right now. So it doesn't happen this way where all of a sudden we're going to have a rate cut in September and then the 30-year fix is dropped. And that's important for people that are waiting for these really low rates to understand. If you're waiting for low rates like 4.5 overnight, next 60, 90 days, you're rooting for catastrophic job loss. You're rooting for real uncertainty in the world. And listen, neither of us know if that's going to happen. What we do know is right now we have a moment in time where the rate is down into the low sixes, 6.25, 6.3 range for you. That's where you're qualifying at right now. And we do know, studying the last 2 years, volatility has gone both ways. We've seen these 6.9, like we just had a week and a half ago, down to 6.3 range swings, these half a point, 0.6% swings on the 30-year fix. But we've also seen them the other direction. We've seen it go up from 6.75 to 7.5 a couple of times in the last couple of years now, haven't we? So that volatility conversation is important. If we can go out and find the right house out of the three that we're looking at for today, save money on this right now, why wouldn't we go ahead and lock in as opposed to waiting for who knows what in the future, right? And these are the conversations. By the way, if you've got somebody who bought in 2022, 2023, are you calling them to tell them about the news of what's going on with the rates right now? Or are you letting your lender do it that worked with them? Maybe it was their lender. Somebody's going to call and let them know. Are you going to call first, or are you going to let the lender catch up this week and make those calls on Thursday? Get out in front of that if you're an agent. If you want lifetime value of a customer, and I know lenders, if the lenders are on here right now, they don't even love me saying that. They want to hold that relationship. Now, if you're a real estate professional, you're the real estate agent, you should be the resource of the entire process. You want to have a client for life? Well, serve them for life. Bring them that information first. They're not paying attention to these headlines at the depth that we are. They don't understand. Oh, yeah, I am at 7.9. Oh, I could get in at 6.25 right now. Interesting. Oh, and you're telling me my home went up in value the last 14 months? So that's going to give me a cushion here? That could be a real conversation that's a benefit to somebody. It could also unlock conversations like this when you call. Yeah, I'm not going to refi because we've been thinking about, actually, this house isn't really working out for us. We've been thinking about in the next couple of years possibly selling. Ooh, next couple of years? That's all of a sudden somebody that's very warm that you want to make sure you're having these conversations with. All right. Looking back here, it kind of diverted here on the analyst and industry analysts on the markets and the rates. This is right inside of your show notes here. We've got the hot sheet show notes every single day uploaded into BAMX for BAMX members. This is what today looks like. BAMX members can tell you in the live chat the benefit that this has been to them. So many of them are using this to copy and paste, using their conversations with their clients, with their database, with their follow-up. You can get into BAMX by using code HOT to get your discount on that. All right, so we've got an analyst at Keefe, Burett, and Woods mentioning that the weak unemployment data, the weak unemployment data fueled this interest rally. Fannie Mae's current coupon is now at 5.05%. 30-year fixed Freddie Mac fixed rate mortgage is expected to fall from the 6.3 range. That's that weekly survey. We know the daily survey obviously is at that 6.3 range right now. Fed funds futures imply the Feds could be cut this 200 basis points by July 2025. So we're looking at the 50 basis points that I mentioned in September, but by July of next year, we could be at 200 basis points. That's 2 points off. So we're at 5.25 to, 5, we could be down into the threes on the Fed fund rate by July of 2025. That's interesting. Bank of America analysts project more than 100 basis point of rate cuts before the end of this year. So definitely under 5 before the end of this year on that Fed rate, according to Bank of America. That's end of the year, not September. Again, that high probability I just showed you with the CME group happens in September, the high probability of the 50 basis points. Borrowers right now can save significantly with these lower rates. Here's an example. A $610,000 loan cost dropped from 1.213 points, 7,400, to 0.375 points, 3,200. Okay, so when you're looking at this data here in the hot sheet show notes, a message out to buyers would be how to save 3,200 this week on your home purchase, right? Like that could be a headline that explains. Now you copy and paste inside of here the information so that they can start to get warm again, get off the sideline, come in and have a conversation so that you can get the opportunity to educate them on what the opportunity might be in this moment. The average mortgage rate, the average mortgage loan amount in the U.S. is $405,000. That right now potentially saves borrowers $100 to $250 a month with where the rates are. Okay, so how to save $3,200 on your loan, how to save up to $250 on your monthly payment right now. Are you still in the game? Let's have a conversation, right? Are you looking to save money on your home purchase? Let's have a conversation. Okay, these are the things you need to be sending out at scale beginning of this week right now to stay in front. If you don't do it, somebody else obviously will. Bond yields have made a huge move lower. Okay, this is from Logan over at HW, and have made a big move up. It's market madness, meaning yesterday, Monday, on the 10-year yield is only down a few basis points, which it came down considerably from where we've been. Mortgage pricing obviously came in lower, but the 10-year was key to how low it would go. And you did see the 10-year kind of sticking yesterday at that 3.7 number, okay? So talking about that, where are we at with that right now? Because I think yesterday's momentum was like, okay, we could continue to see a 30-year fixed drop. But what have we seen in the last 24 hours? We've seen 75%, snapback, bounce back ability from the Japanese market on their stocks. They go worst day, 1987 on Monday. Then they go Tuesday, best day since 2008. Okay, so the markets are recovering. This isn't a free-for-all all of a sudden, okay? And so what does that mean? As you got money flowing in other places, you have a 10-year that's now ticking back up. I could see a higher interest rate today than we had on yesterday's read. Yesterday's read, for as low as the rate got, the best rate we've seen since April of 2023, that's where we came in yesterday, best rate since April of 2023, was still a healthy margin over 6. It was 6.34. Okay, we'll get the weekly to come in at 6.3, as we just read in the show notes there, potentially. But we're at 6.34. This could be right back at 6.4 or over with where the 10-year is starting out today, albeit if the 10-year goes lower, finishes the day lower before this Mortgage News Daily Survey read comes out, then yeah, maybe we stay. But right now, all indications is that the rate will go up a little bit, maybe 6.4 or more. So that's where I say that these are moments in time right now because we've seen huge volatility swings over the past number of years. Okay, past couple of years in particular. All right, if I just move back to 2022, if I take out these two lines, we just focus on the blue line. Look at these swings. Okay, 2022 October 737 down to 599 come February, down to just in December down to 6.13. So you had almost a full point from October just to early December back in 2022. How about going to March 2023? Up over a healthy 7% at 7 point. I'll move into this here a little bit. Oh, that's giving me the whole thing. I don't want the whole thing here. I don't want to go back to 1980. Thank you very much. Let me get back to 2022. Imagine if you could just like go back in time like this, just scrolling through your life. What do I want to go back to? It's not letting me go back there. Maybe it's not letting me go back to the future. I'm stuck in the past. All right, I'll refresh that. Hold on here. If we take a look at this, here we go. We're back. All right. If we take a look at this again, how much volatility have we had in the last couple of years? And I'll just go the last year, so I don't have to mess with that thing again. Look at October 19th, 2023, 8.3%, down to 6.62% come December 14th. But it goes the other direction too. We were under 7% in March, end of March 28th of this year. We were under 7%, 6.91. And then come 2 weeks later, we're back up to 7.5%. So I want buyers to see that. Look at the volatility over the last couple of years. Pick out 3 or 4 of these examples. Hey, we've had these 0.5 point, 0.75 of a point swings down. We've also had just as many of them up. So if you erase everything in a 0.75 point swing up, we get back to 7% in 2 weeks, and we don't take advantage of this now, how would that make you feel? Okay, these are the conversations. If it doesn't make them feel bad, that's fine, but at least you brought them the information. So understanding that you've had these swings in both ways, and just because we're on a downward trend doesn't mean we're going to continue to move in that direction. Again, to get rates really low, you're going to have to see a lot more people lose. You're going to have to get closer to 5% unemployment. You're at 4.3 right now. It's been trending in that direction, but you're almost rooting for a recession. If you're rooting for, somewhere in the mid 5s this year, I'm not saying over time, spread between the 10-year and the 30-year, which we've covered, normalizes and we get into the 5s with normal conditions. Absolutely. The projections from Fannie Mae are, that could happen the end of next year, beginning of 2026. People don't want to hear that. I understand, but that's how it happens without World War III. That's how it happens without epic stock market meltdown. That's how it happens without dramatic ratcheting up of unemployment. It happens slowly and over time. Typical buyer agent, Redfin reporting, earns 2.55 in commission. This is a rate that has declined since the NAR settlement was announced in March. You know how I feel about Redfin if you follow this hot sheet. I don't know many markets left in America outside of maybe really low price. What I'm saying is I'm not saying that their data is wrong. What I'm saying is I don't know many markets in America where this has been the average commission over 2.5. Okay. So they're saying it's come down since the announcement from 2.62 to 2.55. Maybe that's the case. And listen, I know, you're not supposed to talk about commissions. I still think that's a silly, stupid rule. I can look at a market, add up all the commissions, and do an average. It's a math problem. Okay, some people are paying 3.5, some people are paying 2.5, some people are 6, some people are paying 7, some people are 4 or 5. These are all numbers. You put them into a calculator, and you get an average. Okay, this is just this is something that happens in every single industry. You can look at numbers. Numbers are numbers. They're not offensive. They shouldn't hurt anybody's feelings. They kind of just are what they are. But I don't know many agents that are saying that, geez, we've always been up over, it's 2.5. But Redfin's reporting that's down from 2.62 to 2.55. These changes obviously need to be mandated by August the 17th. In dollar terms, a typical buyer agent earns $15,000 per deal, up marginally since January. That's wrong, right? Typical buyer's agent doesn't earn that, Redfin. And this is where Redfin gets, criticism from me for sure, is that they mislead customers all the time. They've been doing it for 2 decades. Okay. They mislead customers on how much money that they're going to save by working with their situation. Then when you look into the deal, it's not the case. And they've changed that rhetoric, recently. They also, are certainly more political activists than they are, a broker of good for agents out there. For customers out there. And then by this saying, the typical buyer's agent. No. Gross commission. And this is what Bravo needs to learn. It's not just Redfin. Everybody needs to learn this. This is what's put a falsehood in a lot of people's minds. Gross commission to the brokerage is this. Then you've got referral fees. You've got costs of doing business. You've got split with the agent. You've got transaction coordinator fee. You've got a lot of different ways that thing gets chopped up over time. And that is something that I think is really important, okay? Because you don't have a buyer agent that's even able to collect the commission. That only a broker can do that. Here's the chart here showing from the 2.6 to 2.55 on the 4 weeks ending July 14th. National, they're calling this a national average buyer agent commission for week rolling period. They're reporting this data now because agent commissions are in the news and consumer minds. We get closer to August 17th. Deadline for NAR affiliate MLSs to implement the changes mandated by the $418 million settlement. By the way, just going into this thing, if you have an agreement with your buyer of what you're worth, you write that into your purchase and sale now moving forward. You really just do that now moving forward from this moment and forever. So you write in your commission into the seller and you negotiate that between, hey, the buyer and I are going to negotiate this, or I'm going to negotiate this directly out of the buyer's pocket, whatever the case may be. Here's where they've declined the most. The average commission paid to a buyer's agent was in Detroit. It was 2.87. See, like this is one, I just don't know many markets that are at 2.87. Okay. That's now at 2.87, down from 3.18. The average commission to a buyer agent in Detroit before July 14th was 3.18. Like, let me know if in your market you're getting over 3% for buy. I think there's a lot of markets where the majority of the homes in America are being sold where that is just not the case, that you're getting over 3% on the buy side. Cleveland went from 2.62 to 2.39. Miami from 2.63 from 2.8 to 2. From 2.84 to 2.63. There was an increase in Cincy. Let's move to Cincinnati. Where's my Cincinnati agents at? Up from 2.93 to 2.95. Commission percentages are the highest in Austin. I think Jeremy Knight's in the chat. Austin, 2.99. I mean, Jeremy, he's got that real flow. Now he's got that Austin commission flow. Jeremy, take me back to the to your club over there in Austin. What a great time that was. Cincinnati 2.95, San Antonio 2.91. There's the lowest, not Nassau County, New York 1.95, Rhode Island, Providence 2.05, Anaheim 2.11. Maybe I'm just talking to too many East Coast, West Coast agents when I talk commissions, and I'm seeing those numbers as opposed to all these other numbers. Okay. Redfin, of course, they put in here. They've always been about lower fee. That's I'm not even going to read that because it's just so silly. We know the case there where they've had to come up to not here. We got the R&R show says she's in Detroit and no, not a 3 point. And this is where I always kind of take Redfin's. I always say this about Redfin's data. Take it with a grain of salt. they might have surveyed 3 people. I'm just not sure how they got that data. And so it might be, I'm just not sure. So just crazy stuff. All right, let's take a quick look here at the 10-year, 3.828 right now on the 10-year. So that is showing, signs of moving up here. Obviously, we had the big move down, yesterday, now kind of moving back up off of that 3.7. Again, 30-year fix came in at 6.34 yesterday. We'll see where that comes in as we move throughout the day. We'll see where that locks in later on today. If you're new to the show, we do this every single Monday through Thursday here on the BAM YouTube channel in the live tab. So if you're on the @Now BAM YouTube channel, that's where we go live every single Monday through Thursday that the stock markets are open. You can get the replays on this. If you're more of an audio person, you can get the replays wherever you listen to your pod, Spotify or Apple. Certainly, we've got the hot sheet gets uploaded in the right after this live gets uploaded there. So if you're more on the go, want to catch up on these shows, at some point during the day, you can get access there. But love for you to consider subscribing here to the @Now BAM YouTube channel. Again, we do this every Monday through Thursday that the markets are open. It's the only live housing specific show on the internet. So if something happens, that relates to housing, we cover obviously everything that's going on with the Fed, the inventory situation, anything that has to do with your housing market, whether it be from, even touching on the political news that impacts housing, to obviously the finance world, all funneling down into housing. We cover it here on the hot sheet. Nobody else does it. Obviously, no paywall on this show. If we're going to show you how to implement, and that's where the hot sheet show notes and all of our slides that we upload every single day, all of our monthly courses, all of our done for you content that we drop every single Friday. If we're going to do that, that's where you would enter in to BAMX. Use code HOT to get 10% off of BAMX today. All right. There you go. That's your hot sheet. I will see you later on here on the main channel with a new Real Word podcast. That'll be up later on this afternoon. And I'll obviously see you back here tomorrow morning, live at 9:30 a.m. on the East, 6:30 on the West. Until then, toodaloo.